Welcome back. Well, a few stocks are really going through the roof as we speak. I don't know whether there's any news on STC, but the stock has suddenly spiked up. It's up close to 15%. MMTC as well. Well, that stock as well is moving higher. TTK Health, let's pull up the intraday chart out there. That one's seeing a bit of a spike up. Now, volume's only around 20,000, so I think we can avoid that one. But that stock is clearly moving higher as we speak. Ambika Cottons as well. Volume's fairly high in today's trading session. That one's up in today's trading session. So from the broader markets, there's a fair bit of traction on some of these stocks. But Tube Investments, remember it's a Murugappa group. Motilal Oswal, they came out with a note earlier today. And Nimesh joins us to detail that for us. Nimesh.
Hi, Mangalam. So it's initiating coverage on Tube Investments from Motilal Oswal. So they've initiated with a buy rating and a target price of 1900. The key reasons why they like the stock and the key triggers for the stock to watch out. One, of course, is that the company, they expect the company to deliver 25% PAT CAGR, and there's going to be growth beyond the auto components as well. So that's a key headline for them. In fact, the company is seeding new platforms for future growth. So that's going to add to the numbers going forward. The acquisition-led growth strategy is something which they like. So if you look at CG Power, which they bought a couple of years back, has been a big turnaround story, and now it contributes almost 33% of the SOTP for Tube Investments. So that's worked very well for them. At a consolidated level, Motilal Oswal expects a revenue CAGR of close to 15% and EBITDA and PAT CAGR of close to 20% between FY22 and FY25. So there is going to be a linear growth for the next couple of years. And in terms of valuations, it's trading at close to 25 times FY23 EPS and only 20 times FY24 EPS. So attractive valuations, strong growth ahead, a very strong group and a good leader. A good combination of straight, clean growth, and hence initiating coverage with a buy rating and a target price of 1900 on Tube Investments.
Okay, all right, Nimesh, thanks a lot for that. Stock holding strong, 4% higher in trade. Prakash, any view on Tube Investments? It's giving you that exposure, and also it has a bit of a bicycle play as well in there.
Yeah. So yeah, I know the BSA brand is something which all of us have grown up with. But Nigel, all these triggers that the report talks about, they have been around for a while. There's nothing that certainly you would discover today and start looking at it from that perspective. So yes, I do agree. It's in a zone where the salience is likely to kind of start building up. The metrics are fairly positive. But what it underscores, so I'm quite positive on the sector as a whole. Industrials, particularly companies which have the strength to manufacture and deliver quality, are the ones that you need to bet on, and that's a global change that's happening for us as a sector, as a economy, and don't miss out on that. So I'm not very particularly charged up just to buy Tube Investment from this perspective, but yes, as a whole, the sector is promising, and you will probably see some of the ancillaries getting towards globalization in terms of scale and quality, and that is something which you can't ignore. So keep an eye on that, but yes, not necessarily to buy Tube Investment at this point.
Okay, fair enough. Got that. Any views on some of the other sort of recent listings? There was Rate Gain. We had the management with us on the program yesterday in the afternoon. Travel software company. There's something like a Map My India. Both came, I think, to the market around the same time. Any thoughts, Prakash?
So, Richard, both of them have a very high level of dependence on certain niche segments. Yeah, and they'll always be vulnerable to vagaries of demand and supply or business dynamics in those segments. So it's a very narrow segment. You carry too much of risk to make that kind of a gain. Out of the recent listings and some of the ones that have come off, the only one that comes to my mind is Policy Bazaar or PB Fintech as it's listed. I think that is something which is galloping into a very different business model. It's living up to the promise that it had. So the price variation that it kind of gave you an opportunity of is something which if you take in your stride, you'll probably be very well off if you were to buy it at sub 600 levels and hold on for the next couple of years as the business unfolds. So I would rather focus on something tested and tried rather than a rate gain, which is quite iffy at that point in time, or a Map My India for that matter.
Okay, all right. Well, Prakash, just a quick check on the markets. A few stocks are moving up. Maruti, what a move that stock has seen. It was more or less dullish, but now it's moved to the high point of the day. Intraday it did come off, but that one, in fact, is flying away. And M&M, I think M&M is another stock that's been doing very, very well. The tractor play, the rural focus, all coming together for the stock. And I think that's at a 52-week high today. Prakash, what do you make of this one? The tractor maker, Mahindra and Mahindra, or would you play some other theme from this space itself? I think my director should just pull out maybe the last 1 year chart of Mahindra and Mahindra and the Nifty, and we'll see the kind of outperformance you've seen. Go ahead.
No, I think I'm so happy you are addressing M&M and positioning it as a tractor player and not necessarily as an SUV player that a lot of us branded with. It carries the burden of being the largest SUV contributor domestically in that sense, and has had a stellar run thanks to that. But it's actually the pickup in the tractor segment which will actually surprise us, Nigel. Going forward, you have some of the best months of tractor sales looking ahead, and the kind of positivity that you see in rural demand, thanks to higher prices of agri commodities, the affordabilities of buying tractors, using tractors, and low labor availability. I mean, it's a great combination for tractor sales. So what you didn't see last year, and then they warned us, right? They warned us about the dip that was anticipated, whether it was a Scotch or whether it was M&M. I think it's going to catch up in a ferocious way. So tractors will be positively surprised, the positive number that will surprise everybody. And of course, some of the new SUV launches might make a lot of sense, but they're still not very voluminous given the issues on the supply of semiconductor and other key components. But I would bet on M&M, continue to betting. I've been positive on it from 660, 670 zones as well. But I think sum of parts still gives you an upside of 20-25% in the next 6 months from here.
All right, Prakash, thank you very much, as always, for joining us. Appreciate it here on CNBC-TV18. Now, Vinay Jaisingh is Managing Director, Portfolio Management Services at JM Financial. He's joining us to take some questions. Vinay, thanks very much for your time. Great to have you here. What have you been doing with the portfolio at JM? Vinay, if you can tell us. I mean, last few weeks when markets have been in a mini turmoil. I mean, some would call it a full-blown one, but what have you been doing?
So, firstly, we believe that the markets are a little bit expensive, may not be with a 5-year perspective, but definitely with a 10-year perspective. You club that up with what's happening globally, the headwinds to margins and earnings risk because of commodity prices, which are softening now, lead us to believe that the markets have 5 to 10% risk to analyst numbers for the next year. You add these 2 points out, and we think there's a 10 to 15% downside risk in the current market levels. Hence, we are trying to create a cash position for the same of a similar amount.
Okay, all right. Well, Vinay, good to have you on the show. So 10 to 15% downside risk, and also you're sitting at closer on 10 to 15% cash, if I got that right. How would you position yourself, though, now in this sort of a scenario? Two-part question there. One is, if you compare the large caps to the broader markets, how would you allocate money out there? And the other one is, in this sort of a scenario, will value, over growth? Is that the preference out there? In the bull market, well, everyone was running behind growth. Now it seems that's turned around. Go ahead.
I think you gave both the answers. So, the fact that we are a little more conservative on the market currently on the earnings growth and so much happening globally. Remember, the liquidity pain has just started. The QT tightening, what will come in September could be twice as much as now. And as far as oil is concerned, you still can't take a call on when will oil go below $100 or $90 levels, courtesy the war. So keeping these two things in mind, we would bet a lot more on large cap over mid cap and mid cap over small cap. I would go to the extent of saying, over 75% in large cap is a safer number to play with. Having said that, moving to the second part, please also don't forget that this is the first time in a couple of years the market has seen on a 1 year basis a fall in overall indices, which means if you are a retail investor, if you were 100 last year, you're currently at 97. And that could also lead to some pressures on the market in the short term. So yes, we would look at, large cap over mid cap, over small cap, and hence value over growth. But today you're getting growth at not reasonable, but at attractive prices for a lot of stocks you wanted to earn. So this is the time to buy them as well.
And what kind of names, Vinay?
Can't talk about names, but I'm going to put it the other way around. As far as thematics are concerned, there are 3 thematics we would like to play. The first thematic is the India resurgence play, wherein you've got the auto names. You spoke a lot about it earlier today. Private banks, FMEG, and building material. The second thing we would like to play is, with the wedding seasons on, there's a lot of consumption names, which are coming up. The third thematic we would like to play is the dollar play. Look at the way the currencies are moving, and if at all you're bothered or concerned about global economic slowdowns, the currency of US could get a lot more sharper, and we need exposure in dollars. So here we want to play the China plus one angle, be it global manufacturing, the pharmaceutical space, or the IT space, which has corrected a lot as well. We would put a lot of our weights out there.
Vinay, at one point in time, what really got the market excited was this China plus one theme. Is that still an opportunity out there? Some of those valuations, some of those stocks which had that exposure, well, valuation-wise, they got very, very frothy. But some of them have corrected now. So is that still a theme that you look to play?
I think so. So I think of it the other way around, right? If, let's just talk about the IT sector for a second, which is similar to the China plus one play. Or the pharmaceutical and specialty chemical sector, which is again bang on line on the China plus one play. Wherever you see a contract manufacturing play and India's productivity being very high and valuations becoming 30 to 35% lower than what it was, and you can see an earnings CAGR of 25 to 30% more, I think that's the space to be in. So you get growth at cheap prices.
Is this just pure valuation-led correction, Vinay, in these names that we've seen? Or at the margin, are there any growth worries or people who are over-optimistic on prospects for growth?
I think it's a little bit of all. Nobody could have deciphered commodity prices going as fast where they went. Some of these players, since we're talking about China plus one angle, had a lot of dependence to China for their raw material. And there, because of the supply chain, which was very, very difficult because of, the COVID-related, policies of China, all that led to costs going up. It takes a quarter or for prices to be passed on to the end consumer as well. Hence, you saw two things. One, top line not growing at the same rate as you were expecting earlier. And second, you also saw EBITDA margins declining for this space. So both of them together led to a lot of earnings downgrade, and then valuations, which itself were frothy, some of them were at 35, 40 times, did come down as well. Though earnings could have been lesser than, PE correction now, which makes it a lot more interesting because you're now saying that valuations are relatively more attractive and you're not cutting earnings a lot more.
The tricky part of the market, Vinay, has been energy. Underinvested, under-owned, suddenly you get a spike up, very, very volatile. It's not a long-term keep in your portfolio, but in the near term as well, I believe you'll not look to play that theme, energy.
So you've said it, you've perfectly said what's in our heart. So we have a tactical trade of 25% out of 100%. And part of that trade, we would be playing on auto names, which gain from a lot of reduction in the inflation or commodity level prices. Remember, commodity as an index is down about 25 to 30%, and price hikes have just come up there. So you have tactical plays, you can play exactly the other way around. As far as energy plays are concerned, purely for India, where you don't have the risk of the market coming in or the government coming in and telling you that, they won't put in some more taxes for prices for what the commodities are earning or for what, the energy space is earning. You really don't have many real true energy plays. Some of the names in the energy sector actually have a negative correlation to oil prices as well, which is, if you can't pass on the price hike to the end consumer, but you still have to sell it to them, your balance sheets are getting clobbered a little bit. So we would be a little underweight in the energy space. We would be 50% underweight in the energy space.
Right, Vinay, thanks very much for your time. Great to speak with you. Appreciate you joining us here on CNBC-TV18 as always. Thank you. Well, the market's, 132 points higher, just under 15,700 once again. It's time for another quick a break here. But as we do that, we'd like to recap all of the big market opinion that we got for you through the course of this week. From Credit Suisse to Citi to UBS, we had a whole host of top market minds weighing in. So listen in to some of that opinion that we got on markets all days this week.
By and large, I think the earnings for the Nifty should remain protected. I would expect a 12-15% growth in earnings to remain supported. I also expect the rupee to weaken.
While the risk reward has turned a bit more favorable with the correction that we have seen year to date, there are still risks. And if you look at our Nifty target for 1 year down the line, June next year, it implies around 5-6% upside. And considering the risks, we would really want a better entry point with more upside where I think the risks can be priced in more adequately.
There is probably a 4 to 5% downside on FY24, Nifty EPS. A large part of it would be, driven in our view by the consumption space. And probably, the stabler ones would be financials and, depending on how the commodities move in the commodity segments.
That we may not really go back to the GFC multiples, which was 7-8x on PE. On the other hand, we think that probably a 12-13 times PE is more likely a bottom, which represents a usual bottom for India. So in that sense, using the FY24 estimates, because we didn't want to really bring down the E and the PE simultaneously, we arrive at something like 13,500 for the index.
India is going to emerge as a much, much stronger market, fundamentally and as far as allocations go. And I think that when markets reverse, which they will at some point in time, we will be among the first and earliest breakouts.